Well, the US Federal Reserve is preparing to cut interest rates this week for the first time since 2020. So where does it leave the Reserve Bank? Well, today, Oxford Economics will tomorrow they'll hold a conference in Sydney discussing this. And its chief economist, Sean Langcake, joins me live now on the set. Sean, thanks for your time.
Look, thanks for having me.
Consumer spending in Australia is being lifted right now by tax cuts, energy rebates. What does this mean for the Reserve Bank and rate cuts that everyone wants to have?
Yeah, they're desperately hanging out for a rate cut. Unfortunately, we think that's going to be some time away. We're not calling for a rate cut until Q2 of next year. There's obviously going to be some movers and shakers in the CPI over the next couple of quarters with the utility subsidies pushing down on prices, but it's still that core measure which is being pushed up by labour costs and weak productivity growth that's going to keep the RBA sitting on their hands for a while yet.
All right, this week, the US Fed is the big one. It's expected to cut rates, and once they do start cutting, is it going to be pretty fast? Will there be a multiple amount of cuts in a row?
We think so. We think that they're going to kick off with 25 basis point cut this week. There are some out there that think 50 points is warranted. We think they're going to be a little bit more cautious than that, and then cut at every second meeting. So another two cuts in total this year, and that's going to be carried over into 2025.
And it's not just the Fed. There's a lot of other central banks. They're all starting to cut, but we here in Australia, it's a long way to go.
It is, and there's plenty of reasons for this. Frankly, they're just further along in their inflation cycle than we are. And in most cases, they took rates deeper into restrictive territory than we did in Australia. If you look across the ditch to New Zealand, much higher interest rates, they kind of crashed the economy a little bit harder, but it just means that rate cuts are that much sooner for them.
Well, one of the reasons why the RBA didn't lift rates as high was to sort of keep the employment market where it's at. And obviously, we've got unemployment at 4.2%. The next numbers come out on Thursday for August. What are you expecting there?
Look, I think the trend that we're going to continue to see is a drift upwards in the unemployment rate. We are starting to see in kind of the market sector, parts of the economy that are more interest rate sensitive, labour demand is tailing off quite a bit. It's been kind of propped up by the public sector, but that there's always volatility in the numbers, but we will kind of keep on seeing that trend drift upwards in the unemployment rate. Yeah,
I think we're starting to see less job vacancies. What's the sort of full employment level that the RBA has been talking about?
Yeah, I think, we'd love to not see the unemployment rate kind of go any higher than 4.5%. I think if that's where we kind of settled at or peaked in this cycle, that would be a great outcome. Unfortunately, there is some pain along the way, but we do have policy in restrictive territory. The cost of that labour market momentum is higher inflation, which is also hurting households across the board.
Now, you've got a conference in Sydney, and I think you're going somewhere, another capital city later this week. But one of the things you're going to talk about is this hypothetical of Trump winning the US election. What impact does that kind of potentially have on equity markets?
Yeah, so we've modelled a lot of different scenarios that cover, kind of a Trump and Republican clean sweep all through the Congress, as well as some kind of divided government scenarios. Basically, there's a short-term sugar hit for equity markets. We'd expect that to be a more positive outcome in those markets than a Harris victory.
Is that because Trump wants to cut taxes for business and things like that?
Indeed, yeah, it's all on the tax cut side, and corporates and kind of wealthier households, they see a sugar hit there. It's kind of in the long run that you kind of see the impacts of higher tariffs and immigration cuts piling up and having a negative impact on long-term GDP.
So potential geopolitical issues could emerge in the coming years if that happens?
Yeah, if not issues, just the fact that higher tariffs just mean higher consumer prices no matter what, and that parlays into interest rates. Not to mention, if you're having fewer people coming into the country, you're damaging your potential growth rate. So there's negative impacts there as well.
All right, now at the top of this show, we had a little grab about housing, and the government's trying to get through its housing agenda and fix housing affordability. I know housing's another topic at your conference. We've got high levels of migration right now. Building approvals numbers are still pretty weak. Are we getting anywhere close to hitting that 1.2 million homes in 5 years target that the government's dreaming about?
Yeah, I would say we've always seen that target as aspirational. Certainly, the way through this housing affordability problem is with additions to supply. Whether or not that's feasible given our current skills and the cost escalation that's happened in the last few years is more debatable. Really, you've highlighted the key problems there. Costs at the moment are still too high to really get approvals off the ground. So, there's more work to be done on that front for sure.
But when do you think things might start to turn around? When's migration potentially going to start easing off? When's the construction sector going to get jolted back into action again?
Well, we'd love to see some interest rate cuts to kind of help that along, but that's kind of looking at the second half next year. That should kick off another cycle in approvals that will be helpful. Population growth is easing and it's coming back down. That is giving the economy a fairly big tailwind in a lot of other sectors, but it is exacerbating those housing cost issues.
All right, and we know we just had the GDP numbers recently. productivity is still pretty low in Australia. Is it AI? What is it that can really get it back, getting it fast again?
It's a fantastic question. Look, the Productivity Commission would tell you that we need kind of less regulation will help getting rid of some red tape here and there, especially in the construction industry. More flexible labour markets, certainly, but there's no real one silver bullet that will get us there. The prospects for AI, especially in Australia, are good. We're a wealthy, highly educated, services-based economy, but we don't really see those kind of key impacts coming until deep into the 2030s, really.
Sean Langcake from Oxford Economics, thanks for coming on the show.
Thank you for having me.